Welcome to the Deep Dive, where we cut through the noise and get straight to the insights that truly matter.
hmm
Today, we're going to pull back the curtain on one of the most critical yet surprisingly overlooked players in the global technology landscape.
Right.
Imagine this. Every time you fire up your new AI-powered laptop, or maybe your company successfully moves another application to the cloud,
Yeah.
there's a strong probability an unseen giant quietly working behind the scenes helped make that complex magic happen.
Absolutely. We're about to embark on a deep dive into the world of TD SYNNX.
Okay.
This isn't just any company. It was formed from a monumental merger that created nothing less than the world's largest IT distributor.
The largest.
The largest. Our sources today are incredibly rich, detailed investment research analyses, industry reports, company filings, the whole lot.
Good stuff.
And our mission is really to extract the most important nuggets of knowledge about this powerhouse. We want to ensure you don't just know about them, but truly understand their profound impact.
You'll walk away from this deep dive not just with a clear understanding of what TD SYNNEX does, but why they are so utterly indispensable, how they're strategically growing in a rapidly changing world, and the larger picture of where the IT industry is headed because of players like them.
That's the goal.
Think of it as your shortcut to being genuinely well-informed about a company that's quietly yet fundamentally powering our entire digital lives.
Okay, let's unpack this unseen architecture.
Let's do it.
So let's start at the very beginning with the big bang that formed this massive entity. What exactly is TD-SYNNX, and how did it manage to become so incredibly large, seemingly overnight?
Well, the Big Bang indeed happened on September 4, 2021. That's when two titans of the IT distribution world, the SYNNX Corporation and Tech Data Corporation, officially merged.
Right, I remember that.
And this wasn't just another corporate acquisition, it was a truly transformative transaction. It immediately created the world's largest information technology distributor.
By revenue. By both revenue and overall market share. And this sheer unprecedented scale is, without a doubt, their defining characteristic. It's the foundational element of their competitive strength. It's almost impossible to overstate the impact of that single event.
Wow, the largest. That's a huge claim in such a competitive industry. But what does that kind of monumental scale actually look like in practice for a company like this? How does it manifest into tangible advantages?
It's immense.
Yeah.
It really is, and utterly pervasive. Think about it. They operate with a truly global footprint, serving over 150,000 customers
150,000.
in more than 100 countries worldwide.
Okay.
To give you a sense of the vast ecosystem they orchestrate, they connect products from over 2,500 different technology vendors.
Wow.
And we're talking major household names like Apple Inc. and HP Inc. With this vast and incredibly fragmented customer base, their trailing 12-month or TTM revenue currently sits at approximately $60 billion.
60 bucks.
And they employ around 23,000 people globally. This isn't just a number. This incredible size is a primary source of their competitive advantage.
Yeah.
It gives them leverage that smaller players simply cannot match. It's like they built the superhighway for tech.
That immense scale isn't just a number, it's a strategic weapon. Let's delve into how they actually wield that power in the market. How does that kind of global reach translate into real competitive power, a genuine edge?
Well, that global footprint and their massive purchasing power gives them significant leverage with original equipment manufacturers, or OEMs, and software vendors.
Right.
Imagine if, say, Walmart or Amazon could not just negotiate prices, but control access to nearly every customer you'd ever want to sell to globally.
Yeah.
That's kind of the influence TD-SYNNX wields. They're able to secure highly favorable pricing, advantageous terms, and crucial product allocation that smaller competitors simply cannot command.
So more than just discounts.
Oh, absolutely. This isn't just a discount. They can influence product lines, market entry, even a vendor's entire go-to-market strategy for certain regions.
Wow.
Beyond that, their extensive global logistics and supply chain infrastructure is, frankly, a marvel of efficiency. It creates operational efficiencies in inventory management and product delivery that are exceptionally difficult and capital-intensive for anyone else to replicate.
Right, the barrier to entry there must be huge.
Exactly. This logistical and purchasing prowess makes TD-SYNNX an indispensable channel partner for both vendors seeking efficient global market access and for customers like value-added resellers or VARs and system integrators who need a reliable single source for a vast array of IT products and services. They effectively manage the complexity of the supply chain for everyone involved.
So this unseen giant operates with truly immense scale and wields significant market power.
But scale alone isn't enough, right? It's what they move that makes them indispensable. Let's peel back the layers to understand the distinct types of technology they're actually distributing. Is it just boxes of computers, or is there more to it than that? Not at all. It's far more nuanced than just boxes. TD-SYNNX actually organizes its vast product and service offerings into two primary portfolios.
Okay.
And this reflects a kind of dual strategy to serve different, yet interconnected parts of the IT market.
Makes sense.
The first is endpoint solutions. These are the products typically found at the edge of the IT network, the things directly interacting with end users.
Like PCs, phones.
Exactly. Personal computing systems, mobile phones and their accessories, printers, peripherals, other consumer electronics. Growth in this segment is often tied to technology refresh cycles.
Right, like when companies decide to upgrade their entire fleet of PCs or a new iPhone comes out.
Precisely. Or when new generations of smartphones launch, driving consumer demand.
Okay, so that's the stuff we're all familiar with, the devices we interact with every single day. What about the other side of their business? What's housed within this advanced solutions portfolio?
The other side is advanced solutions. Now, this is where the higher value, more complex technologies reside, the true foundational backbone of modern enterprise IT infrastructure.
The heavy lifting stuff.
Pretty much. This includes critical data center technologies like servers, storage, networking equipment. But it also encompasses crucial and rapidly growing areas like enterprise software, comprehensive cybersecurity solutions, hybrid cloud deployments,
Okay.
and other high-growth strategic technologies such as big data and analytics, artificial intelligence or AI, and the Internet of Things or IoT.
Got it.
And a key part of this segment is their Hive Solutions business.
Hive.
Yes, Hive Solutions. It specializes in designing and delivering custom server and storage solutions specifically for the hyperscale data center market.
That hyperscale data center market sounds like a world unto itself. Can you quickly paint a picture of just how massive and demanding those environments are and why a custom solution from Hive is so critical there as opposed to just, an off-the-shelf product?
Absolutely. Good question. Hyperscale data centers are the colossal digital factories that power cloud services like Google Search, Netflix streaming, AWS's massive infrastructure. You name it.
The backbone of the internet, basically.
Pretty much. They are built for extreme efficiency, density, and reliability. An off-the-shelf product simply wouldn't cut it. Hive designs systems that are precisely tailored for these environments, optimizing everything from power consumption to cooling, ensuring maximum computational density within a limited footprint,
Okay.
and integrating seamlessly into existing, often proprietary architectures. This specialization allows them to deliver performance and cost efficiencies that are critical for the world's largest digital platforms. This segment is undeniably where the future growth and higher value are concentrated within the broader IT landscape.
Given that strategic emphasis on advanced solutions, are they seeing this reflected in their financial numbers, in their overall direction?
Absolutely. The Advanced Solutions portfolio is indeed central to their strategy for driving future growth and expanding overall profitability.
Makes sense.
And geographically, all regions are contributing to this shift. In their second quarter of fiscal year 2025, for example, the Americas revenue grew by a solid 5.3% to $9.9 billion.
Okay.
Europe saw even stronger growth, up 10.5% to $4.9 billion.
Wow.
And the Asia-Pacific and Japan, or APJ segment, grew 8.7% to $1.9 billion.
Mm.
The APJ segment in particular has shown strong momentum. Its non-GAAP gross billings grew an impressive 19.5% year over year in the first quarter of fiscal year 2025.
Almost 20%.
Yeah. This really indicates successful market penetration and expansion in those higher growth, higher value areas.
With all this talk of their deep integration and indispensability, a natural question arises. In an age that often seems to be moving towards direct consumer models, sophisticated cloud marketplaces, is an intermediary like TD SYNNEX truly still needed? What's the actual value of a distributor in this evolving digital landscape?
This is a fundamental question, really.
Yeah.
And it's core to understanding their enduring relevance. TD SYNNX functions as a critical intermediary, performing an essential aggregation role. Yes. They aggregate supply from literally hundreds of technology vendors and simultaneously aggregate demand from tens of thousands of customers. This dual aggregation creates immense value for both sides of the IT channel.
How so? For the vendors first.
Okay, for their vendor partners, they provide an outsourced sales and logistics channel. They offer immediate access to a highly fragmented global customer base that would be prohibitively expensive and complex for individual vendors to serve directly.
Right, managing thousands of small partners would be a nightmare.
Exactly. IDC research, for instance, even estimates that a vendor can incur costs of up to $6,000 annually to manage each channel partner directly.
Wow.
That's a burden significantly mitigated by leveraging a large distributor like TD/SYNNX. They also manage credit risk, provide crucial marketing support, and help vendors execute their go-to-market strategies at a scale that's otherwise unachievable for many.
That's a huge outsourcing advantage for vendors, simplifying their global reach. But what about for their customers? The VIRs and system integrators you mentioned, what crucial value do they extract from this relationship?
Right, for their customers, primarily those value-added resellers and system integrators. TD/SYNNX offers a single-source procurement platform, access to a massive, diverse catalog of products and solutions from nearly every major tech vendor, all in one place.
Convenience, essentially.
Convenience, yes, but also more. Crucially, they provide essential financial services, including extending credit.
Ah, the financing aspect.
Yes, and that's increasingly vital as the industry shifts towards operating expense, or OpEx, and subscription-based models.
Right, the as-a-service shift.
Exactly. These models can often strain partners' working capital as they transition from large upfront sales to recurring smaller payments. TD/SYNNX helps bridge that gap.
Okay.
Beyond logistics and finance, they deliver significant value-added services, technical support, specialized training and certification programs, and expert assistance in complex solution design and integration.
So they're really enabling these smaller players.
They are. They're not just moving boxes. They're enabling businesses to build sophisticated IT environments without having to juggle hundreds of vendor relationships themselves.
So they're much more than just a warehouse and a shipping service. They're truly embedded in the financial and technical aspects of the IT channel. But what about that elephant in the room? The potential for disintermediation from major cloud marketplaces. AWS, Microsoft, Google. Couldn't those platforms eventually cut out the middleman?
That's a very real long-term threat, yes. And it's something TD/SYNNX is acutely aware of and actively addressing.
Oh.
Well, public cloud marketplaces could allow software and service vendors to connect directly with end customers, potentially making a traditional distributor focus solely on logistics vulnerable. No doubt about it.
Right.
However, TD/SYNNX's strategic response is to proactively evolve, to shift from merely being a distributor to becoming a solutions aggregator and an ecosystem orchestrator.
Solutions aggregator, ecosystem orchestrator. What does that mean in practice?
It means adding layers of value that these marketplaces don't easily replicate. Think about it. Bundling multi-vendor hardware, software, and services into seamless, complex solutions, providing deep, specialized technical expertise that helps customers integrate these diverse technologies, offering sophisticated lifecycle management and flexible financing options that span multiple vendors.
So simplifying the complexity.
Precisely. Their digital platform, Streamone, is absolutely key here.
Streamo.
Yeah, it allows partners to procure, manage, and bill for multi-cloud and multi-vendor solutions, all through a unified, simplified interface. This strategic pivot aims to transform them from a potential victim of disintermediation into an essential partner, simplifying complexity for everyone involved.
That's a very proactive and ambitious shift, transforming their role from middleman to essential orchestrator. But with a company of this scale, how challenging is that cultural and operational pivot? Are there significant headwinds in that transformation itself?
Oh, it's undoubtedly a complex undertaking. I mean, the challenge lies in changing decades of established operational practices and mindsets, right?
Sure.
It requires significant investment in new platforms, retraining thousands of employees, and evolving vendor relationships from purely transactional to more strategic partnerships.
Yeah, that cultural shift from box mover to solutions consultant sounds monumental.
It is. However, their advantage is their immense scale and existing relationships. They're not building this from scratch.
Right.
They can leverage their financial strength to make these investments, and their deep vendor and customer ties mean they have an established audience that's likely eager for these simplified solutions.
Yeah.
It's definitely a heavy lift, but they have the resources and the market position to execute it.
Okay. When we look at their financial reports, there are two terms that pop up quite frequently: revenue and non-GAAP gross billings. Why is this distinction so important for us as listeners trying to understand their actual performance? How should we interpret them?
This raises a really important question about how to truly interpret their financial health and underlying business momentum. Let's use a simple analogy first.
Okay.
Imagine you're a car dealer. You sell a car to a customer for, say, $30,000. If you own that car outright, the full $30,000 would be your reported revenue, right?
Makes sense.
But what if you're just selling it on behalf of the manufacturer and your commission is, say, $3,000?
So the customer still pays $30,000, but my business only directly sees $3,000 of that as income, correct?
Precisely. In that second scenario, your non-GAAP gross billings would still be the full $30,000
Got it.
because that represents the total value of the product or service that moved through your hands. Management often emphasizes this metric, gross billings, as a more accurate indicator of their true scale, their market penetration, and the overall volume of business flowing through their channels.
Right. It shows the sheer activity.
Exactly. It gives a clearer picture of the sheer amount of technology they're facilitating.
Okay, that makes sense. So gross billings is the total value moved regardless of how they account for it. And how does revenue fit into that?
Your reported revenue, in that second car dealer scenario, would only be your $3,000 commission.
The net amount.
Yeah, exactly, the net amount. For certain types of transactions, especially in software and cloud services, where TD SNX acts more as an agent rather than taking full ownership of the inventory, revenue is recorded on this net basis. This means that instead of recognizing the full transaction value, only the gross profit or commission that TD's SNX earns on that transaction is recognized as revenue. It's an accounting nuance, yes, but it has significant practical implications for the reported numbers.
So what does this all mean for us as listeners trying to understand the company's financial story? Why should we care about this accounting detail beyond just the numbers?
Well, this accounting distinction significantly impacts both their reported revenue figures and consequently their gross margin percentages. For example, if there's a strategic shift in their product mix towards more of these net recognized sales, maybe a more high-margin software or recurring cloud services, it will actually lower their reported revenue.
Lower revenue. That sounds bad.
It sounds counterintuitive, right? But it will simultaneously increase their reported gross margin percentage. This happens even if the absolute dollar amount of gross profit they earned remains the same. To illustrate, in their second quarter of fiscal year 2025, they noted that a greater percentage of sales being presented on a net basis positively impacted their gross margin by approximately 31 basis points.
Okay, so you need both numbers.
Precisely. By analyzing gross billings growth alongside revenue growth, you get a much more complete and accurate understanding of their actual business momentum and underlying operational strength. You avoid being misled by what might seem like a revenue decline on its own. They also highlight other key metrics, non-GAAP operating income, operating margin, adjusted ROIC, free cash flow, for a holistic view.
Got it. Look at both gross billings and revenue. Now that we have a solid understanding of TD SYNNX and its unique structure, let's zoom out a bit to the broader industry. How large is this global IT distribution market, and what are its key characteristics and growth drivers?
It's a truly vast and incredibly mature industry, often described as the foundational backbone of the entire technology supply chain.
The backbone.
Yeah. According to estimates from Canalys, a leading technology channel analysis firm, the global IT distribution market stood at an astounding U.S. $463 billion in 2024.
Wow, nearly $500 billion.
Exactly. And what's particularly notable about this sector is its high degree of concentration. The top 15 distributors command over 61% of that massive market.
Highly concentrated, then.
Very much so. This implies significant economies of scale and high barriers to entry, which we touched on earlier, really solidifying the positions of the few dominant players like TD SYNNX.
So it's massive and concentrated. Is it a growing market, or is it more of a stable but maybe stagnant giant? What are the underlying forces propelling its growth, if any?
Oh, absolutely. It's a growing market.
Yeah.
Its expansion is propelled by several major, undeniable secular trends in technology adoption.
Like what?
Well, think about the proliferation of cloud computing, the explosion of artificial intelligence capabilities, the Internet of Things rapidly connecting our physical world, and the ever-increasing demand for robust cybersecurity solutions in an age of constant threats.
Right, all huge trends.
Exactly.
Right.
And as technology itself becomes more complex, more fragmented, and increasingly integrated into every facet of business, the distributor's role in aggregating and simplifying this inherent complexity becomes even more critical.
So complexity actually helps them.
In a way, yes. The market is also undergoing several structural shifts. A clear move towards more digital platform-based business models,
Hmm.
an increasing emphasis on value-added services over pure logistics, and ongoing industry consolidation as players seek even greater scale and specialization. So it's definitely growing and evolving dynamically.
What's truly fascinating here is that TD SYNNEX isn't just big. It's considered to have what economists call a wide economic moat. For our listeners, what exactly does that mean for them? How does it fundamentally protect their business from rivals?
Right, a wide economic moat. It's a term used to signify deeply embedded, sustainable competitive advantages that protect a company's long-term profitability and market share from rivals.
Okay.
For TDSYNX, this moat is deeply rooted in several mutually reinforcing factors, layers of competitive advantages that strengthen each other.
Such as?
First, and perhaps most importantly, are scale economies. As the world's largest IT distributor, their purchasing volume is enormous. We mentioned the $60 billion revenue. Well, their gross billings were $80.1 billion in 2024.
80 billion.
Yeah, their buying power is larger than the vast majority of the individual vendors they distribute for. This provides unmatched cost advantages and negotiating leverage with suppliers, which smaller competitors simply cannot replicate. It gives them preferential access and pricing.
So size truly equals power and efficiency here, giving them a significant leg up that's incredibly hard to replicate. What else contributes to their wide protective moat?
Second, their business model benefits from a powerful network effect.
Network effect. How does that apply here?
Well, their extensive portfolio of over 2,500 vendors attracts that massive customer base of over 150,000 resellers and integrators.
Right.
In turn, this enormous customer reach makes TD SYNX an absolutely essential channel partner for any vendor looking to gain efficient, widespread global market access.
Ah, I see.
It creates a virtuous cycle where each new vendor adds more value for all customers because it expands the product catalog, and each new customer adds more value for all vendors by expanding the market reach. It's like a buzzing marketplace that gets more valuable the more participants join.
Okay, makes sense. What's the third factor?
Third, they possess significant intangible assets that have been built up over decades of operational history.
Intangible. Like what? Brand.
More than just brand. Think deep, embedded relationships with key vendors and customers. These are relationships fortified by integrated IT systems, established credit lines, and a deep understanding of their partners' specific business needs.
So they're deeply intertwined.
Exactly. It means their systems talk seamlessly, their credit lines are intertwined, they often co-develop go-to-market strategies. It creates a sticky web of interdependence and high switching costs for both their suppliers and their customers, making it very difficult for them to easily move to a competitor.
So it's not just about getting the product from A to B. It's making sure A has exactly what B needs when they need it across 100 countries, all while managing finances and relationships. That must be a logistical nightmare without their expertise, like trying to conduct a global orchestra where every musician plays a different tune.
That's a perfect analogy, actually, for the operational complexity they manage daily.
Who are their closest rivals in this space? When you look at the competitive landscape, who are they primarily up against?
Their primary publicly traded competitors are Arrow Electronics, ticker ARW, and Avnet, trading as AVT.
Arrow and Avnet, okay.
Insight Enterprises and SIT also competes, though maybe with a somewhat greater focus on direct solutions and services rather than pure distribution.
Mm-hmm.
And on the private side, Ingram Micro is another key competitor of comparable scale. Though, being private makes direct comparison a bit more challenging due to less public financial data.
Right. How does TD SYNNEX stack up against these rivals, particularly Arrow and Avnet, in terms of sheer scale and market position? Are they truly head and shoulders above the rest?
TD-SYNNEX is indeed the clear market leader by revenue. We mentioned that TTM revenue of $60.01 billion.
Right.
That's more than double the size of Arrow, which reports around $28.50 billion,
Right.
and Avnet at about $22.20 billion.
Wow, more than double.
Yeah, but what's truly fascinating here, and a crucial differentiator, is the business mix.
How so?
Arrow and Avnet both have significant electronic components distribution segments. They serve the manufacturing supply chain, semiconductors, other parts.
Okay, components, not finished goods.
Largely, yes.
Hey.
This is distinct from TD-SYNX's primary focus on finished IT products and comprehensive enterprise solutions.
So what does this all mean for us? Why is that difference in their business mix so important when we're trying to understand TD-SYNX's competitive position and maybe resilience?
You.
Does the market reward one focus more than the other?
Well, this difference in business mix suggests that TD-SYNX's financial performance may inherently be more resilient and less volatile than that of its component-focused peers.
Why is that?
Aero and Avnet, being heavily exposed to the highly cyclical semiconductor and electronics manufacturing industries, are prone to pronounced inventory cycles and significant demand volatility. Their earnings can swing wildly with chip shortages or gluts.
Right, we've seen that play out.
In contrast, TD-SYNX's business is more aligned with enterprise and consumer IT spending budgets, which, while still cyclical, have historically been less volatile than those manufacturing cycles. Plus, their strategic focus on the advanced solutions portfolio, with its more stable and recurring revenue streams from cloud, software, managed services, that further insulates them from the extreme cyclicality of the hardware manufacturing sector.
So, more stable.
Generally, yes.
Yeah.
And this resilience is often reflected in how the market values them. Just look at the last 12 months, revenue growth percentages recently. TD-SYNX was at a positive 2.7%. Aero was at minus 3.9%, Avnet minus 6.6%, and Insight minus 7.6%.
Quite a difference.
It clearly shows their relative strength in what was a challenging environment for many.
Given all these advantages and their established position, how hard is it for a new player to even think about entering this global IT distribution market? Are the barriers to entry truly formidable, or is there still room for disruption?
The barriers to entry are indeed formidable. They act as a powerful protective layer for incumbent players like TD-SYNX.
Like what, specifically?
Well, new entrants would face immense working capital requirements just to finance the necessary inventory and accounts receivable. I mean, imagine needing billions just to get started.
Yeah, that's huge.
Then there's the prohibitive cost of building a competitive global logistics network. We're talking warehouses, transportation fleets, sophisticated IT systems across over 100 countries. This isn't just expensive, it takes years, maybe decades to perfect.
Right.
And finally, there's the monumental time and effort required to establish the trusted relationships with thousands of vendors and tens of thousands of customers that TD-SYNX has cultivated over decades. It's just not a market you can jump into easily. It requires a level of investment and trust that few, if any, new players could ever hope to amass quickly.
And what about the long-term disruptive threats? We touched on disintermediation from cloud marketplaces before. Is that still their primary challenge looking ahead, or are new threats emerging that we should be aware of?
Indeed. The most significant long-term disruptive threat remains that potential for disintermediation, particularly from those powerful cloud marketplaces operated by hyperscalers, AWS, Microsoft, Google.
Still the main one.
It seems to be. These platforms could, in theory, allow software and service vendors to bypass the traditional distribution channel over time. Additionally, major OEMs could theoretically choose to increase their direct sales to end customers or resellers.
But you said that's less likely at scale.
Yes, as we discussed, the sheer complexity and cost of serving a highly fragmented market directly make that less probable at a truly large scale for most vendors. And crucially, TD-SYNX's proactive strategy of becoming that value-added solutions aggregator and ecosystem orchestrator,
Right, the pivot.
rather than just a simple logistics provider, is a direct and robust defense to mitigate these very risks. They're not standing still waiting to be disrupted. They're actively trying to shape their future role.
Let's transition now and look at the numbers, seeing how all these strategic decisions and market dynamics play out in their financial performance. How has their revenue growth unfolded over the past few years, especially with such significant market events like the merger?
Right, the financials.
Yeah.
Their trajectory reveals a history of significant growth, but it's punctuated by some major strategic transformations.
Okay.
To really understand it, we have to go back to SYNX Corporation initially. Before the merger, it had two segments, Technology Solutions and Concentrix.
Concentrix, the BPO business.
Exactly, their business process outsourcing segment.
Yeah.
After spinning off Concentrix in December 2020, the standalone Technology Solutions business was already a substantial player, with $20 billion in revenue in fiscal year 2020. This was before the monumental merger.
$20 billion on its own. Okay. And then, of course, the big merger with Tech Data happened, which fundamentally changed everything. How quickly did that impact their top line?
Exactly. The merger with Tech Data in September 2021 was a quantum leap in scale.
Right.
For fiscal year 2021, which only included about 1/4 of the combined operations, revenue jumped to $31.6 billion.
Okay.
But in fiscal year 2022, the first full year of the newly combined entity, revenue nearly doubled, reaching an impressive $62.34 billion.
Wow, nearly doubled in a year.
Yes. It clearly illustrates the massive inorganic impact and the immediate scale advantage gained from that merger. It instantly created a behemoth.
But I noticed a dip in revenue in fiscal year 2023. What exactly happened there? Was that a sign of trouble or merely a market adjustment after that pandemic boom?
In fiscal year 2023, revenue did decline by 7.7% to $57.56 billion.
Yeah.
However, it's critical to understand this wasn't indicative of a strategic misstep or some fundamental business problem with TD SYNNX specifically.
So market-driven.
Mostly, yes. It reflected a broad market normalization following that pandemic-induced surge in IT spending. The primary driver of this contraction was a sharp downturn in the personal computer market.
Ah, the PC slump.
Exactly, which disproportionately affected their lower-margin endpoint solutions portfolio. During this period, though, they intelligently continued to invest in their higher-value advanced solutions segment, positioning themselves for future growth. It was more of a healthy market correction that they navigated, rather than a self-inflicted wound, you could say.
So it sounds like they successfully navigated a tough market correction. What's the latest in terms of their growth? Are they back on an upward trend, and what's driving it now?
Yes, absolutely. As the PC market began to stabilize and demand for foundational technologies like AI, cloud, cybersecurity solutions accelerated across enterprises, TD SYNNX returned to growth. Revenue in fiscal year 2024 recovered to $58.45 billion.
Okay, back up.
And recent quarterly results show accelerating momentum. Q2 FY25 revenue grew a robust 7.2% year-over-year.
Nice growth.
And the strong 12.1% year-over-year growth in non-GAAP gross billings in the same quarter further underscored that the underlying business momentum is robust. Their strategic focus on those higher growth advanced solutions areas is truly yielding positive results. They're benefiting from the broader tech recovery.
Distribution is often seen as a very high-volume, low-margin business, as we discussed. So how has their profitability evolved, especially after integrating such a massive merger, which can typically be a drain on resources?
Right. Given the inherently high-volume, low-margin nature of the distribution business, even small changes in profitability metrics are incredibly significant.
Every basis point counts.
Exactly. Post-merger, TD SYNNX has demonstrated effective cost management and impressive synergy realization. Notably, their gross margin increased from 6.3% in fiscal year 2022 to 6.9% in fiscal year 2023.
That's a decent jump for this industry.
It is a substantial percentage gain in this industry, yes.
What specifically drove that margin expansion? Was it just aggressive cost-cutting or something more strategic, perhaps tied to their evolving business mix?
That margin expansion was indeed driven by a couple of key strategic factors. First, that favorable shift in their product mix towards those higher margin advanced solutions we discussed.
Selling more valuable stuff.
Right. As they sell more complex, value-added services and software, which inherently carry higher profit percentages, their overall gross margins naturally improve.
Makes sense.
Second, it was also influenced by the accounting treatment of more revenue being recognized on a net basis, which, as we detailed earlier, can technically increase the gross margin percentage, even if the dollar amount of profit is consistent.
Right, the net accounting effect.
Yes. What's also impressive is that their non-GAAP operating margin has remained remarkably stable, hovering in the 2.7% to 2.9% range since the merger.
Stable despite the huge merger integration.
Exactly. This is really a testament to their ability to control selling, general, and administrative, or SG&A, expenses, even while simultaneously integrating a massive new business. While their GAAP operating income is, as expected, impacted by merger-related costs like amortization of intangibles.
Accounting noise.
Pretty much. The non-GAAP figures provide a much clearer view of the core operational profitability of the combined entity.
For a business that relies on a large asset base to generate profits, capital efficiency is absolutely key. How do they measure up with important metrics like return on invested capital, or ROIC, and return on equity, ROE? Especially given the post-merger adjustments?
Good question. Prior to the merger, the legacy SYNX business was quite efficient, generating a strong adjusted ROIC of 11.5% in fiscal year 2020.
Pretty good.
Yes. However, the acquisition of Tech Data added billions of dollars in goodwill and intangible assets to their balance sheet. This significantly increased their invested capital base, the denominator in the ROIC calculation.
So the math changes.
Exactly. As a result, an accounting-driven near-term decline in ROIC was mathematically inevitable due to that larger denominator. It wasn't necessarily a drop in efficiency, just counting.
Got it.
However, management actively aims for an adjusted ROIC that is 2% to 4% above their weighted average cost of capital, or WACC.
Could you quickly clarify what WACC means for our listeners? Just a quick refresher.
Certainly. WACC, or weighted average cost of capital, is essentially the minimum return a company needs to generate from its investments to satisfy both its debt holders and its equity investors.
The hurdle rate.
Exactly. Think of it as the hurdle rate. It reflects the total cost of financing its assets. So if TD-SYNNX is consistently achieving an ROIC that is 2% to 4% above their WACC, as they aim to, it suggests they are truly creating economic value from the capital they employ. Their reported adjusted ROIC of 9.7% in Q1 FY25 suggests a very positive trajectory. It indicates they are well on their way to generating significant economic value from the merger as synergies are fully realized and their earnings power expands.
And ROE.
Their trailing 12-month return on equity, or ROE, also stands at a solid 8.91%, which is quite respectable for a company of their size and in this sector.
What about their balance sheet? You mentioned the goodwill from the merger. Are they carrying a lot of debt now, and how healthy is their financial foundation to support this massive global operation?
They maintain a strong investment-grade balance sheet, which is crucial for a company of its scale and for the roles it plays in the financial ecosystem, like extending credit.
Investment grade is key.
Absolutely. As of their latest reporting, their total debt was approximately $4.1 billion. Management actively targets a gross leverage ratio that's debt to EBITDA of approximately 2.0x. Their current ratio of 2.27x is consistent with this target, indicating healthy short-term liquidity.
Okay, managing it well.
Yes. Maintaining investment-grade credit ratings is incredibly important for them. It allows them to secure favorable terms on their debt, which keeps their cost of capital low. And it also supports their crucial vendor financing programs.
Right, the partner financing.
Which are a key part of their value proposition to partners, effectively becoming a banking arm for many smaller IT businesses. Liquidity is also robust, supported by $767 million in cash and cash equivalents and access to significant revolving credit facilities. This gives them ample financial flexibility to weather market shifts or pursue strategic opportunities.
The period from 2022 to 2024 saw a lot of market turbulence, lingering supply chain issues, the post-pandemic correction, geopolitical shifts. How did TD-SYNNEX manage through that significant IT market volatility? It must have been quite a test of their operational resilience.
Oh, this period was indeed a true test of their operational resilience.
Yeah.
And they really navigated it with remarkable agility, I'd say.
How so?
After that unprecedented demand surge during the pandemic, the PC market experienced that sharp correction in 2023.
Right, a slump.
And that was the primary driver of their 7.7% revenue decline in that fiscal year as demand for personal devices softened significantly. However, management successfully navigated this downturn by focusing intensely on cost controls and meticulous working capital management.
Batten down the hatches.
Pretty much. By 2024, they observed an improving IT spending environment, a trend that is continuing into 2025, which supports their return to top-line growth.
Okay.
And while supply chain disruptions were a major headache across the entire industry in 2022, creating chaos for many,
Oh, yeah, I remember.
those issues have largely normalized now. This period actually reinforced the critical, essential role of distributors like TD-SYNNX in helping partners manage inventory, secure components, and navigate supply complexities. They essentially acted as a shock absorber for the broader tech supply chain.
Interesting. So the disruption almost highlighted their value.
In many ways, yes.
And what about the broader economic picture? High inflation, rising interest rates, global uncertainty. Did those macroeconomic headwinds significantly affect them, or did they find opportunities amidst the challenges?
Well, the macroeconomic environment of 2022-2024, characterized by high inflation and rapidly rising interest rates, definitely presented both significant challenges and some unique, almost counterintuitive opportunities.
How could challenges first?
On the challenge side, higher interest rates naturally increase their borrowing costs. They cited that as a headwind to earnings per share.
Makes sense.
Broader economic uncertainty also led some enterprise customers to delay or even scale back large-scale IT projects, temporarily softening demand in their advanced solutions segment.
Right, tightening the belts.
Exactly. However, and this is the interesting part, this environment also powerfully highlighted the value of their financial services.
How so?
Channel partners, facing their own cash flow pressures due to economic uncertainty, relied more heavily on TD-SYNNX for essential credit and financing to manage their working capital.
Ah, so demand for their financing went up.
Precisely. This often meant extending payment terms or providing specific financing packages for large projects. They essentially became an even more vital banking arm for countless smaller IT businesses that might not have access to traditional credit in tight times. Sometimes, tough times truly reveal where the deepest, most resilient value lies in a business.
That's a fascinating insight that economic headwinds can actually strengthen their indispensable role. Now, the Tech Data merger was absolutely huge, a truly monumental undertaking. How well did they integrate such a massive business? Mergers, as we know, can be notoriously difficult and often fail to meet their lofty expectations.
What's truly fascinating here is that the integration appears to have been executed with remarkable effectiveness. It really looks like a masterclass in merger integration.
Really? That's successful.
It seems so. Large-scale mergers are, as you said, fraught with risks, operational disruption, culture clashes between two large organizations, often a failure to achieve projected synergies.
Right.
However, TD SYNNEX announced that the merger delivered an impressive 30% non-GAAP EPS accretion in its first year.
30%.
Yes, actually exceeding their initial expectation of 25%.
Wow.
The relative stability of their operating margins and the consistent generation of strong free cash flow throughout the entire integration period further indicate disciplined and successful execution by the management team. This smooth integration significantly de-risked the investment case, suggesting that the largest operational hurdles of combining these two giants are now firmly in the past, allowing them to focus on growth.
Were there any notable leadership changes during this period, especially after such a massive, successful merger? And if so, how did that impact strategic continuity?
Yes, there was a significant leadership transition recently. Patrick Zammit was appointed Chief Executive Officer in June 2024.
Okay, new CEO.
Yes, succeeding Rich Hume, who had skillfully guided the company through both the merger itself and that critical initial integration phase.
And Zammit, where did he come from?
What's important to note is that Zammit is a longtime executive who came from the tech data side of the business.
Ah, an internal promotion, essentially.
Exactly. This ensures a strong sense of continuity and deep institutional knowledge and leadership, while also bringing, a fresh perspective to the top role. It maintains stability during a crucial post-merger phase. It's not an outsider coming in, but someone who knows the combined entity intimately.
Okay, that makes sense for continuity. How does a company this big decide what to do with its immense cash flow? What's their strategy for shareholders, and how do they balance crucial investments with returning capital?
TD-SYNNEX has a very well-defined and consistently executed capital allocation framework, and it prioritizes returning a significant portion of its robust cash flow to shareholders. They have a stated medium-term goal of returning approximately 50% of their free cash flow via both dividends and share repurchases.
50%, that's substantial.
It is. And this commitment is evident in their recent actions. In fiscal year 2023, they returned $751 million to shareholders, followed by another $750 million in fiscal year 2024. So demonstrating consistent follow-through on that promise.
That's a lot of cash going back to shareholders. How have those specific programs impacted the company and its stock?
Indeed. Their share buyback program in particular has been quite aggressive. It's meaningfully reduced the number of shares outstanding by 5.86% year-over-year as of the latest reporting period.
Okay, shrinking the share count.
Right. And as of Q1 FY25, approximately $1.7 billion remained on their share repurchase authorization, providing ample capacity for future buybacks. This reduces the share count, making each remaining share technically more valuable.
And dividend.
The dividend has also been a reliable component of shareholder returns, with a history of consistent growth. The most recent quarterly dividend of $7.44 per share represented a 10% increase over the prior year, signaling confidence in their ongoing cash generation and commitment to direct shareholder returns.
So what does this all mean for the sustainability and resilience of their business model, especially when it comes to cash flow generation? That point you made earlier, that a downturn can actually free up cash for them. It's a truly fascinating insight. What does that enable them to do that their less fortunate peers can't? Are they able to go on offense when others are on defense?
This leads us to a really important, almost counterintuitive point about their free cash flow profile. TD-SYNNEX is a prolific free cash flow, or FCF, generator. They essentially pump out cash, which is the gold standard for a robust distribution business.
Consistent cash machine.
Pretty much. They generated an impressive $1.3 billion in FCF in fiscal year 2023 and $1.2 billion in fiscal year 2024. This strong, consistent cash generation provides the financial flexibility for their capital return program, strategic investments, and robust debt management. What's truly fascinating here, and a defining characteristic of strong distributors, is the counter-cyclical nature of their cash flow.
Countercyclical. Explain that again.
In a typical company, a revenue downturn usually means less cash coming in.
Right. Less sales, less cash.
For a distributor, the opposite can often be true. When revenue growth slows or even declines, the requirement to invest in working capital that's inventory and accounts receivable also decreases.
They don't need to buy as much inventory or fund as many sales.
Exactly. They can then collect on existing receivables and sell down inventory, which effectively releases a significant amount of cash onto the balance sheet. This dynamic was clearly demonstrated by that robust $1.3 billion of FCF generated during the down revenue year of FY 2023.
Wow, so they generated more cash when revenue fell.
Yes. This counter-cyclical cash flow profile is a significant source of financial strength. It allows them to be opportunistic during market downturns by aggressively repurchasing shares at lower prices or paying down debt, strengthening their position ahead of the next recovery cycle. They can absolutely go on offense when others are scrambling defensively. It's a truly unique and powerful advantage.
Looking forward then, where does TD SYNNEX see its biggest growth opportunities in the rapidly evolving technology landscape? Where are they placing their bets for the future?
Management has clearly articulated a strategic imperative to outpace the overall IT market by intensely focusing on what they call high-growth strategic technologies.
Okay, the buzzword areas.
Pretty much. These crucial areas, which include cloud, data, AI, IoT, security, and hyperscale infrastructure, represented a significant 26% of their non-GAAP gross billings in Q1 FY25.
Over a quarter of their business already.
Yes. They are clearly positioned as the primary engine for future growth, shifting their mix to where the market is moving fastest.
Let's break those down a bit. What exactly are they doing in the cloud space? It seems foundational for almost everything else in modern IT.
Cloud is indeed a cornerstone of their growth strategy, and their StreamOn platform is absolutely key here.
StreamOn again?
Yes. It's that sophisticated multi-cloud aggregation and management platform that empowers their channel partners to seamlessly procure, bill, and manage cloud services from all the leading hyperscalers, AWS, Microsoft, Google, as well as a wide range of software as a service or SaaS vendors.
So the central hub for cloud?
Essentially, yes. This positions TD SYNNX as a critical enabler, helping partners navigate the complexity of multi-cloud environments. They recently announced a strategic collaboration agreement with AWS aimed at accelerating cloud and AI adoption across the Americas. That's a tangible example of this strategy in action, showing deep integration with major cloud players.
And AI. That's everywhere right now, dominating the headlines and shaping so much of the future. How are they positioning themselves to capitalize on that massive trend?
For artificial intelligence, or AI, they are strategically positioning themselves through their Destination AI program.
Destination AI.
Yeah. This initiative is designed to provide partners with access to a carefully curated ecosystem of over 60 AI vendors.
60 vendors.
Plus essential technical expertise, specialized training, and ready-to-deploy solutions. The program intelligently targets key growth areas such as AI infrastructure, the powerful hardware required to run AI.
Right, the GPUs and servers.
Exactly. Also, the emerging category of AI-enabled PC, generative AI applications, and MLOps, which is about managing the lifecycle of machine learning models from development to deployment.
So end-to-end AI enablement.
They are essentially building the crucial bridge for their channel partners to participate in and profit from the AI revolution, providing everything from hardware to software and expertise.
And cybersecurity, another absolutely critical area for every business, large or small, across every industry. What's their play there?
Yes. For cybersecurity, addressing a massive and ever-growing market due to the constant evolution of threats, they offer a truly comprehensive portfolio.
More than just software licenses.
Oh, yes. This includes access to over 100 pre-built solutions from more than 50 leading security vendors, covering everything from endpoint protection to network security and data privacy. But this is supplemented by a robust suite of value-added services.
Like what?
Like security assessments, specialized engineering support, and even something called a cyber range for hands-on partner training.
A cyber range, like a virtual training ground.
Exactly. So they are not just distributing products, but actively providing the tools, expertise, and training to help their partners build resilient cyber defenses for their end customers.
Beyond these specific technology areas, what broader market trends or emerging catalysts could really boost their business in the coming years? What's the next big wave they're potentially riding?
Several market catalysts are poised to drive significant demand for TD SYNNX's offerings. First, we anticipate a major PC refresh cycle.
The upgrade cycle.
Yes, and it's expected to be significantly boosted by the introduction of AI PCs.
Right, the new buzzword.
These new machines, designed for AI workloads and boasting enhanced capabilities, could drive a strong wave of upgrades in the endpoint solutions segment as businesses and consumers seek the latest performance.
Okay, AI PCs driving hardware sales. What else?
Second, the ongoing undeniable imperative for digital transformation within the enterprise sector will continue to fuel demand for the cloud, data analytics, and modern infrastructure solutions that comprise their advanced solutions portfolio. Companies just keep needing to modernize.
Constant pressure.
Absolutely. Finally, the broader industry shift towards subscription and consumption-based business models, what's often called everything as a service, or SaaS,
Disastrin.
that plays directly to the strengths of their streamlined platform. And it reinforces the distributor's essential role in managing complex, recurring billing and subscription life cycles across multiple vendors. They're well positioned for these long-term structural changes, transforming from simply selling products to enabling ongoing services.
No business, no matter how strong, is without its risks, though. What are the key headwinds and potential risks TD-SYNNEX faces that we as listeners should be aware of for a balanced perspective?
It's always important to consider these carefully for a balanced view. Primary business risks include supplier and customer concentration.
Relying too much on a few big names.
Potentially. Historically, both Apple Inc. and HP Inc. have individually accounted for over 10% of their total revenue.
Okay, that's significant.
It is. Losing a major supplier or experiencing a significant adverse change in their business terms could have a material impact on their operations and financials. They're also inherently exposed to economic cyclicality. Their performance is intrinsically linked to the health of the global economy and the broader cyclical nature of IT spending. Downturns can certainly soften demand.
And what about the competitive environment and their financial risks? Are those significant factors that could pose challenges?
Absolutely. The IT distribution industry is intensely competitive, which, as we've discussed, leads to persistently low gross margins across the sector.
Constant pressure on margins.
Always. That intense competition means they're constantly fighting for every percentage point of profit. The long-term strategic risk of disintermediation from cloud marketplaces or direct selling OEMs remains a potential headwind. Though, as we've discussed, their strategic pivot is a direct defense against this.
Right. Financial risks.
Financially, they operate with a significant absolute debt load, currently around $3.9 billion, maybe closer to $4.1 billion depending on the latest report.
Okay.
While this is actively managed to maintain investment-grade ratings, a material increase in interest rates would raise their debt servicing costs and could pressure net income.
Sure.
And as a global entity operating in over 100 countries, they are also exposed to foreign currency fluctuations, which can create volatility in their reported financial results, adding another layer of risk to manage from quarter to quarter.
So after all this detailed analysis of their operations, strategy, financials, what does this all mean for how the company is valued in the market today? What's the context for its stock price, and how should we interpret its current standing?
Right, valuation. Looking at their valuation multiples provides important context. Their trailing 12-month, or TTM, price to earnings, PE, ratio is approximately 17.4x.
17.4x. How does that compare historically?
It's currently above its 10-year historical average, which is around 15.1x, but it remains below prior cyclical peaks. So not historically cheap, but not at a peak either.
Okay. What about forward PE?
The forward PE ratio, which is based on analyst estimates for their earnings over the next 12 months, is a more modest 11.7x.
Lower. Suggests growth expectations.
Yes, it suggests expectations for strong earnings growth in the near future, which is quite common for companies emerging from a downturn or investing heavily in growth.
What about EBITDA?
Their TTM enterprise value to EBITDA, or EBITDA, multiple is 9.3x. Now, this represents a recovery from a 5-year low of around 6.5x, but it's still well below its 2020 peak of nearly 14x.
So recovered, but not frothy.
Exactly. This indicates that while the valuation is normalized from its recent trough, it doesn't appear to be at an extreme or speculative high relative to its recent history.
How do they compare to their peers on these valuation metrics? Do they trade at a premium or a discount, and what would explain that difference?
Well, the valuation multiples for the primary distributors, Arrow, Avnet, Insight generally, they're clustered in a relatively narrow band, which is characteristic of mature, low-margin industries with strong cash flow.
Makes sense.
TD-SYNNEX trades at a modest premium to its closest large-scale competitor, Arrow Electronics, on a PE basis, while trading roughly in line on an EV/EBITDA basis.
So slightly higher PE than Arrow.
Yes. For example, TD-SYNNX's TTM-PE is 17.4x compared to Arrow at 13.2x, Avnet at 15.4x, and Insight at 13.5x.
Okay, why the premium?
This slight premium seems warranted, I think, given its undisputed market leadership and its business profile, which, as we discussed earlier, is arguably more resilient and focused on higher growth IT end markets compared to its component-focused peers like Arrow and Avnet. The market seems to be rewarding that strategic positioning and less volatile business mix.
So it's not just bigger, it's valued more highly per dollar of earnings. Why do you think the market gives them that slight edge? Is it solely because of that more resilient business mix we discussed, or is there something else at play? Perhaps the impressive execution on that massive merger?
I believe it's likely a combination of factors. The resilient business mix, with its stronger emphasis on advanced solutions and less exposure to the extreme cyclicality of component manufacturing, certainly plays a role. I mean, investors often pay a premium for more predictable and stable earnings, right?
Sure, predictability is valuable.
But you've hit on another crucial point: the excellent execution of the tech data merger. In a world where so many large mergers fail to deliver on their promises, TD-SYNNX's ability to not only integrate smoothly, but actually exceed EPS accretion targets. That speaks volumes about management's capabilities.
Execution premium.
You could call it that. That de-risking of a massive operational challenge, combined with their strong free cash flow generation and commitment to shareholder returns, likely contributes to the market's willingness to assign that slight premium.
And on the flip side, what are the arguments that might keep their valuation in check or even argue for a potential discount in different market conditions?
Right, the counter-arguments. Factors that might support a discount valuation include the inherent low-margin nature of the distribution business itself. That limits overall profitability and may naturally cap valuation multiples compared to, say, a high-margin software company.
Low margin industry, lower multiple ceiling.
Generally, yes. The business also remains exposed to the cyclicality of IT spending and the broader economy, which can always introduce uncertainty and risk. They carry a large absolute debt load, which, while well managed, introduces a degree of financial risk, particularly in a rising interest rate environment. And of course, the long-term disintermediation risk we've discussed, where cloud marketplaces or direct selling vendors could potentially bypass them. That remains a conceptual overhang for investors. It's the constant balance of these elements, the strong advantages versus the inherent risks, that defines its market perception and ultimately its valuation. Hashtag outro.
Wow, this has been an incredible deep dive into a truly foundational company. We started with the question of what happens behind the scenes to power our digital world. And we've discovered a true giant in TD-SYNNX, an unseen but absolutely essential force.
Indeed. TD-SYNNX is a fascinating example of a foundational company that's successfully transforming itself, moving from a traditional distributor into a sophisticated solutions aggregator and ecosystem orchestrator.
Right, that pivot.
They're cleverly leveraging their massive scale and strategic focus on the cutting edge of technology, navigating complex market cycles and macroeconomic shifts, all while consistently returning capital to shareholders. It's really a masterclass in adapting to change within an established industry.
So what does this all mean for you listening? Next time you hear about the latest advancements in AI or a company making a big move to the cloud, I hope you'll remember the unseen architects like TD-SYNNX. They are the ones making those innovations possible by solving the complex logistics, the intricate financing, and the technical integration challenges that most of us never even consider behind the scenes. They're the silent partners in our digital progress.
This raises an important question for all of us, I think. What other hidden giants are quietly powering the tech trends we obsess over, solving problems we don't even know exist? And what would truly happen to our interconnected digital world if they weren't there? Their absence would certainly be felt profoundly.
Exactly. A great thought to end on. Thank you for joining us on the deep dive. We hope this exploration into TD-SYNNX has given you a fresh, insightful perspective on the vital, yet often invisible infrastructure that underpins our interconnected digital world. Until next time, keep digging, keep learning, and keep appreciating the unseen forces that drive our technological future.